Okay, welcome then. Let's start with this with the webinar here. So thanks for joining. I'm Giuseppe Basili, also known as the FIB Stalker, and in this webinar today, I'm going to talk about the importance of risk-free trading. Today is November the 24th, 2017, and this is an FX Trade webinar. So thanks for the opportunity. As usual, so the disclaimer, trading is risky. There's a lot of risk in the market. We're going to talk about that today. Anything I say, it's my own opinion, and it's for your it's material for your general information. And this is the usual disclaimer. So if you are watching the presentation now, please just have a look at it. So thanks for joining, Adam, Gregor, Nick, Linda, and more are coming in here. So we're going to start anyway. I won't talk about myself. I think you know a little bit about my background. And in case you can always review the other presentation I've offered here on FX Trade. I'm a premium contributor to FX Trade now since 2014, and it has been a great experience, and I hope I'll be able to continue. So these are some of the organizations I've been working with. Interesting enough, I mean, this year is the first time I went to the IFTA, and now I plan to go every year. I'm associated to the CIS TA, the Canadian Society of Techie Analysts, and also the Italian Association of Techie Analysts, and they're both under the umbrella of the IFTA. These years, IFTA was in Milan, was in Italy, my own country, and it's a great experience, and I look forward to Kuala Lumpur next year. So I'll give you some details about that. I've been doing a lot of research. This is one of my research paper was awarded recently. If you want to learn a little bit about my work, you can always come to winningwithalgos.com/start, and there is also a 6 hours free course for you if you are interested. So winningwithalgos.com/start. All right, so these are some other papers I've written, and my contact information, I'll give that to you later on as well. Welcome, Tom, as well. So let's start then. Why risk-free trading is important? And let me do a quick check here. How many of you know what risk-free trading is? Please give me a yes, a why, if you actually know or think you know what risk-free trading is. Go ahead, give me a yes or no. If it's a no, that's fine. Go ahead. Adam, Gregor, Nick, Tom. Do you have an idea what risk-free trading is? Yes or no? Write it down. And there may be different definitions or different ways people think about risk-free. And probably the most obvious one is moving the stop loss to entry. Okay, I rarely do that, and I'll explain you why. Risk-free trading for me is something different, and so let me cover quickly the agenda here. We're going to talk about risk management in trading. Well, there is a lot that's been written about risk management, but obviously it's never enough. Risk-free and reduced risk in trading, and what's their meaning, and how we obtain risk-free trades, how to properly generate risk-free trades, and how to manage them, and then a little bit more about why risk-free trading is important. But by the time I've finished, you'll understand why it's very, very important. Actually, it's life-changing. I'll then show a few examples of recent trades, things that went well, that didn't go well as well, and also situation where there's very little we can do because the market, for the way it behaves, is going to beat us in any case. But that's part of the game, and if we have enough time, we'll do a brief market review of the majors as well. So, as you know, in the market, there is a lot of risk. There's always a lot of risk around. Markets are risky. Risk should never be underestimated in the markets. In fact, my 100% job is managing risk when I trade. I don't think about gains. I just think about risk. And the reason for that is when I'm able to abate and reduce risk as much as possible, then I know that profits will take care of themselves. If I have a low risk entry and I've managed the risk properly and I've entered properly as well, and I can generate very quickly a risk-free trade, my job as a trader has ended. And the reason for that is we have no control on price. The only control we have, it's not on the markets and ourselves, and in writing the best trading plan we can that adapts to the current situation. All right, so markets are risky in certain conditions, particularly, for example, when there are ranges or there's indecision, and they're less riskier in other conditions, like, for example, when the market are trending. I love trending markets, obviously, like probably all of us, because the risk is much less and it's easier to obtain a risk-free trade, which again is the objective of this webinar. There are many participants in the market, and you have to have an edge. You have to be able to understand who's in the driving seat. And actually, smart monies are always in the driving seat. Okay. And there's another group of participants that I call the dump money. And actually, rarely they are in the driving seats. And when they are, it's an emotional behavior. And they really don't have a view where to bring price, where targets are, and so on. So I use smart money that I believe is the group that understand what they're doing, large banks, professional traders, program trading, algos, to basically use, and I try to stalk and identify what they're doing in order to understand the bigger picture of market structure. And then there is what I call the dump money, the traditional tech analysts, crowd, trend following, discretionary traders, and the traders that do not have a clue but believe that being a trader is cool. So very risky because in the end they are the effects of direct and indirect decision making. And the direct decision making is made by me and you, although all my decision making is rule based and based on written trading systems, but I execute manually. I do not execute automatically. I don't believe in that, and I don't think that there are some of the things I do very difficult to actually do automatically. Of course, they could be done, but it's a lot of work. So at the end, it's the interaction of humans, whether directly or indirectly through their work, which could be represented by algorithms, for example. Now, risk management, I think you very well know what risk management is. I will give you a simple definition here in the context of retail trading, which is what we do. It's a way to protect our precious capital, and this is rule number one. PPC, always remember that: protect precious capital. When the money is gone, the game is over. And risk management is also a way to ensure that the market tells you when you're wrong, and you should always get out when that happens. So when a simple way is to always have a stop. I'm surprised, and I remember a study, or it was a statistics of many years, a few years ago by Oanda, and they mentioned that 21% of their traders, they would always and regularly hit margin calls, which means that they don't have any minimal concept of risk management, obviously. And 21%, I believe, it's not the real picture. The real picture is, the real number is much higher. And risk management is also a way to help sticking around until you learn the trading game, because it takes time to do that when you don't have any help, like myself. I mean, I had little help, but Really, you really always have to learn trading in a way that works for you. And of course, we build on the shoulders of giants, but then somehow each and every one of us will have its own way of looking at the markets and having uh, and probably doing things in a certain way. I believe it was Alexander Lerner who wrote that when someone came to him apologizing for the fact that he was not using exactly the system as he was describing in his book, well, he knew he had the winner in front of him. So that's one way to say it. So how to practice risk management? First of all, accepting risk. Look at the downside. Look left, like when you are in England and you are walking. So look at the downside. Look always at the risk. Don't look at the gains. The gains will take care of themselves. The gains that will come. The other thing is, if you're starting already 1% or less at the beginning, at least. When I give these figures to some of the people, they say, "Well, I mean, if I reach 1%, I mean, I'll never get ahead." Well, probably 95% of people never get ahead because they don't understand the importance of money management. If at the beginning you risk only 1%, you can produce steady returns, then by using money management, you can reach your trading objectives. Only trade after price confirmation, and I have a number of mechanisms that I use, including the Fibs Talking Timing technique, which is a proprietary technique that I teach to my students, and also consider adopting a free risk trade approach. Now, the free risk trade approach works together with money management to reach traders' objectives, and that's what I want to show you today. Now, when it comes to trading, as you know very, very well, there are many things to know. Alexander Elder said any clients can buy and sell a financial security. But most importantly, trading is a business, and you have to not to take no needed risk like you would do normally in a business. Sometimes people are surprised how hard I work on my trading, um, and 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 actually, the reason is that I treat that as a business. I wake up very early, I review the market a couple of hours, then if there are long-term position, I would identify those, I recommend those, and then I start looking at the market as they develop during the European Open and the US Open. That's my routine, and basically every hour I'll review all the charts that are already annotated, and I go on for 9 hours, and I take it very, very seriously. Also, you don't have and you should not be taking very large risks. I mean, you can do that when you know that you have an expectancy system with a valid expectancy, and you know that you're limiting your losses in a maniac way. You have to be maniac about that, about managing risk, and then you can do that. But initially, I would say that it's a good idea. Most ignore also the basics of trading. They only look at the mechanics of trading, which is the method, the entry, the plan, but there's much more to that, way more to that. And I believe that the key to success is to produce steady monthly gains, and then applying money management and keep growing your account. So that's the secret. And you can risk very small amounts initially, and then build on that. Of course, it's interesting to have a system that can produce 10, 20 unit of risk and gain every month or more, and there can be such good times. Sometimes it's not like that, but that's the way to go. So there are two main things that you need to have: a positive expectancy method, a method that generates in average money for each trade. In average, each trade means that be losses as well, but in average, if you average through all the trades, each trade actually generates a gain. And that's what a positive expectancy means. And the other most important is not to lose money. If you don't lose money, if you manage risk properly, again, gains will take care of themselves. So now, fire forget is what we would love to, everybody would love to have. I mean, to put up a trade and just forget about it. But let's be realistic. And I talked about fire forget in the past as well, but we need to be realistic. We need to really to ask, is that really possible? And if you have a little bit of experience in the markets, you know that you must expect anything from the market. Anything can happen in the market at any time. So how do you actually account for this behavior of the market? This is a principle which, if you have read Trading in the Zone, it's the first principle that is laid out in that book. Anything can happen in the market. So how you reconcile this? How do you factor this in your trading? And it might take several years to incorporate such rule in trading, such principle. That's what happened to me. So two of the many factors that we have to consider are confirmation levels, and I spoke about this in the past. So you might want to review some of the webinars of the past, and risk-free trading, which is what I want to discuss now. Risk-free trading does not mean that risk in trading can be eliminated, not initially at least. When you put up a trade, anything can happen. If anything can happen, and can happen from the very start, the very moment that you put on a trade, you know that you can lose that amount, right? So risk-free trading is not really removing risk from trading. That's impossible. But removing risk from your trade as soon as possible, that's what risk-free trading is. And what it means to remove risk. And obviously, by being a business, trading as a risk. We don't really want to become statistics here. And one way we can remove risk is by taking out part of the position when the price moves in the direction of the trade. Okay, I'm sure you might be familiar already with this concept, but whenever I told to traders, also traders with some experience, actually they never they don't fully understand the concept of risk-free trading. So if we have a market, and let's say we have a reason to believe that this market is gonna go higher like this, then what we could do, and this is just a simple example here. Actually, we're going to have an entry level, and we're going to have a stop level. Okay. Now, this is our pip risk, or that can be translated in a dollar risk as well. Okay. Now, if we take the same distance from the entry, and this is an example, we are talking about a long entry, but the same can be said for a short. So if we measure the same distance in the long from the entry to the stop, and we project it in the direction of the trade, we have the risk-free level, and which is this green line here that you see. Okay, this is our risk-free level. So risk-free trading simply means that whenever price gets into the risk-free level before hitting the stop, okay, we take half of the position out. This is one way of making the trade risk-free. Why? If we take half of the position here and we never move the stop, which is here, if the market after hitting this level reverses against us and hits the stop, right, then we're going to lose the same amount that we took on the other half of the position. So we took half of our unit of risk. The unit of risk is this distance here. Half of this was taken when price reached the risk-free level. Another half is lost, minus half, half of R here, when price and if price gets back to the stop level after the risk-free level has been hit. So you can really see here that if we adopt this approach, we're going to end up with nothing. Actually, we're going to lose the cost of trading. Trading as a cost can be very small depending on who you trade with and how long you have been trading and what's your volume and so on. All right. So, but the point here is that if you are able to consistently take low risk entries that majority of the cases hit this first target, then you can have something that is risk-free. You have eliminated your risk from the market. Of course, it's a business. There's always risk involved. We know that the market can go crazy. We know that your stop might not be hit. We know that something like the Swiss franc joke at the beginning of 2015 and so on can happen. These kind of things can happen, okay? And this is the risk of doing business. This is the risk of life. It's not something that you can eliminate. But what you can eliminate, that in normal conditions, the normal functioning of the markets, if you take half of your risk at the risk-free level, if you take half of your position at the risk-free level, right, and the entry and stop are here. So if you take half of your position at this level here, you may keep enjoying whatever you are doing without ever worrying of this trade, and that's the closest that I know to fire and forget. Okay, there is nothing closer to fire and forget than this approach to trade management, at least in my experience. If you have a better one, I'd love to hear about it. Okay. Now, the important thing of this approach is that you can really go with your own life and never worry and sleep and do happily whatever you need to do, and most importantly, you may let the market do whatever it needs to do. We have no control on the market and price. Price can do whatever it needs to do, and so when you do this, basically you never move the stop. You determine the stop in using a procedure that would minimize it to be hit in the context of this low risk opportunity, and you can let the market move. And there are only two possibilities: either the market comes back to stop you out, in which case you didn't lose anything, just the cost of trading, or the market, in this case it's a long, gets into the target, okay? Or you just remove it at some point because it's not going anywhere. But for in intraday trading and trading on the smaller time frames, that never happens, basically, right? I mean, you might exit before, but these are the two cases: either success, or I'll call it half failure. Half because you're not losing money, you're just losing the cost of trading. Now, some people mistake in risk-free trading for actually the alarm that you hear, it's the alarm on my chart, so sorry about that. Some people believe risk-free trading is moving the stop. We never move the stop. You need to let the market do whatever it needs to do. And some people make mistake and instead of taking alpha out here because they don't want to lose on gains if the market continues higher, then what they do, a big mistake, they move the stop to entry. Big mistake. And I'm going to show you an example later on. Now, mind that this idea that you're going to lose on gains if you reduce your position on half, it's out of not understanding how successful trading takes place, which is through money management, not through being right often. We don't have to be right. Okay, so we have to have a proven edge that, of course, has as high as possible expectancy, but this idea that people don't want to exit half of the position here, it's out of non-understanding how the tools that we have to reach our objectives in trading, and money management is a very powerful tool. Okay, so don't be worried about that. And now let me show you some example from real trades, recent trades. And I'm going to show you 3 charts, Australian dollar, Swiss franc, US dollar, Japanese yen, US dollar, Swiss franc. And what I'm going to do, I'm going to actually show, starting from the Australian Swiss franc. Okay, so this was this was a play originated by the analysis on a larger time frame. Okay, and let me do that analysis again. So I give you a little bit of context also, the way I built the case for the trade. So basically, this market has been moving laterally here for several months, and when we look at the larger time frame, this is a weekly time frame, we can see that there is clearly a direction chart. Now, my observation is that this market has, on the weekly time frame, he had traded the 50% here. That happened in June here. Okay, June this year. So the point is that he reached previous highs and was not capable of bringing price into that first target. This is the first target smart money is looking at when they trade and participate this kind of levels. By not being able to go above these levels, the immediate, well, it's not immediate, of course, but it takes weeks for that to be tested. But then when this market started moving lower here, the conclusion was that we were due for a second test here. And I'm just applying the rules of my methods, and you know, that's something that I've been doing for many years. So so what happens here is that there is a case then for a continuation lower. Doesn't mean that the market is going to continue lower like a straight move. Even this move here, it had a lot of tradable retraces, and that's exactly what we want, right? But we know that eventually, at some point, very probably, the 71.82 is going to be retested. So that was for me the case. And then what we had to do, we had to find a good entry area. And again, I've applied, and notice how you know, this 50% from the lows to the recent highs is acting as a resistance, but eventually it will let go. And the reason for that is 50% have never held in this range. And very probably, doesn't mean that he might not hold this time, but very probably is not going to hold. Okay. Of course, there is participation at the data because there is still a group of smart money and algos that want to try to push that higher. Okay. So the opportunity here was an extension short from previous lows to whatever lows that were printed. Okay, and went down to the time frame on the 4-hour time frame, and you know, that was properly taken. That trade, I took the trade, I timed it on a smaller, even smaller time frames, and we were good. All right, so I applied risk-free trading, so we were risk-free around 175.30, and the market continued lower, so everything was good, right? The problem came when I lowered the stop, and I lowered the stop before the swing high was actually the actual swing high was reached, because you know, we saw this participation at this 50% here, so I thought this was the swing high, put the stop above the 61.7% level here, but then the market stopped us out, okay? Had I not moved the stop, right, the market would have done this, you know. Yes, we are giving back a little bit of gains, but who cares? We are risk-free on this trade. At least that's my approach. I'm risk-free. I can think to other opportunities. That's the way I see it. The way I see it is that our job as traders is to create risk-free trades, and that's it. Because we have no control on the market, that's the only thing we can do. Would you agree that that could be an interesting way of looking at trading? What's really the objective of trading? We are paid for the quality of our decisions, and to me, it's to make sure that I take a low risk opportunity when there is very little possibility for price to retrace against me. Look at how much this price is retraced already, right? So it's not a breakout, it's not a breakdown, it's making sure the price has already retraced against me and people are in pain, because imagine that at each of this level, there is someone, at each of these levels here, there is someone who went short this market. Short, 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 short. So they are all in pain. Okay? So whenever price gets here, that's a low risk area. Why? Because there are a lot of people who are short from lows here, who are ready to buy back and exit because they're in pain. And when they buy back, what happens? If they're short, it means that they sold, right? They have to buy back. Okay, by buying back, they generate volume for algorithms. Okay, so that's the logic and the reason why this kind of trades works. But I wanna elaborate on the risk-free trading here. So we were risk-free here, and despite where we put the target, which was much lower here, we could let this trade go, and this trade would still be good because we would be around here now, still with a risk-free trade, half of the position on, but because we lowered the stop here, so we locked in not only the 0.5 half of unit of risk that we actually locked when the trade became risk-free. I also wanted to lock more. What happened? The market punished me. All right, so risk-free trading, never move the stop. It's not the stop that is moved, and the stop was above these highs here. It is half of the position that is taken out at the risk-free level, which is when you have 1 unit of risk in gain. Okay, and never move the stop. Any questions in relation to this? Go ahead. If you have any questions, you can write them down. We'll go to the next example. This was the Japanese yen here, and this is a good trade. On the other hand, beautiful technical market here, and this is one of the market I really love because of it being very, very technical. When I say technical, it means that it fully respects the traces that model the smart money, as well as, of course, dump money. So this market had 50% long, and smart money has reacted a number of times to this level here, as you can see, many, many times, which means that the level is reduced. And these are this area here. Sorry, I'm using the wrong color. But smart money is always basically on the long side, but as well as on the short side. So So which means that there is another group here that also was actually pushing this price lower and still doing that. They're still doing it. So for months, if you have now realized this market has been moving in this range. So it's very probable that what we know about this market is that it's going to retrace into 108.70. Okay, and we are in the process now of putting a reaction in this market, and at the end of the reaction, firmly believe that we're going to continue. Mark my words, and so. So we know the direction of this market. It's now. Of course, there is some support from some of the dump money here that I represented with some of these moving averages. But the point is, it is a very technical market. Let me show it to you. We had a very good sequence of 50% retraces in this market. In fact, we had 350% retraces. Okay. So 50% to first target and actually second target, and but the before the second target was hit was another 50% sequence of measure move, the first target. And if you're not familiar with this way of tracing, this is part of the Stalker methods. I invite you to go to that link I've sent you before and take the free course there. And first target and then second target. Okay, sorry, no, first target here, and then again there was another sequence, another 50% from highs to lows, other participation in this area, and that's the trade we took. Okay, so that's the trade we took, one of the trade we took, and this was a 50% participation here, timing on a smaller time frame using the flip stalking timing techniques. He went to the first target, and actually you don't see it, but there's a second target here to the pip, and this second target is right here, 110, 111 and 10. Okay, that's the level that I've used. And so when we and this is on the daily, when we look at the 4 hour, the entry was here, the stop was here, became risk-free very, very quickly. And then this time we didn't change anything. We just let the market move. Okay, and in 2 days we went to target. I also took a second trade in this market, and it was a breakdown, a daily breakdown here. And the reason for that is the first target was here. There was really nothing below price. So there was very, very easy possibility to get a risk-free trade. And remember that now we have, you know, if we use the same color we were using before, the entry is here. The stop is the red one, it would be here, and the risk-free trade level, which we can use also in this case, would be somewhere here. Okay, so as you can see, the risk-free trade level was before. Sorry, just deleted everything. But here the point I wanted to make is that the risk-free trade was before the first target. Okay, so very high probability of being hit. Okay, does it make sense? Yes, no, maybe. Does it make sense? Give me a yes if it makes sense. If you have any questions. Any questions? No? So I can continue. So in this case, we didn't move the stop. I didn't do anything. And I got the risk-free trade, and then we got the 2 trades to target for almost 6 units of risk in gain. Okay, so and 6 units of risk in gain includes the risk-free trades. Okay, so normally this would have been the way you calculate the risk-free, the reward to risk, and I call it adjusted because we use risk-free trading. It's basically the reward to risk, original reward to risk plus 1 to take account of the alpha that we exit divided by 2. So can you see that the original reward to risk was much higher because the adjusted risk was around 6, a little bit less than that, which means that the reward to risk, right, was basically 11 for the two trades together. Okay, 11 unit of risk. So now you may say, well, why should I give up 11 unit of risk, and only keep the 6? Because if you can do this consistently, instead of, for example, having your R being 1%, now you can make your R 2%. And this is a very simple way of using money management, but there are other more sophisticated way where you use markets money as well, and you can review the webinar on FS-Suite as well. Okay, so can you see that if you can do consistently this, and you manage risk properly because you use risk-free trading, so you protect your capital, you take profits early, you make sure that something goes wrong, you don't lose anything, you can do multiple of this by working on money management. And that's the main message that I wanted to give in the webinar here. Now, the last example is something that really there was very little we could do, and that sometimes happens. The market throws you a ball, a curved ball, and then here we had another 50% retrace, which we traded. This is the US dollar Swiss franc daily time frame. Okay, what happened here is that we traded a 50%, which was from recent highs on the daily to the lows that were at that moment. Market retraced 99.41. We took the trade and we put the stop above highs, and in here, either moving or not moving would not saved us. The market came to marginally above and stopped us out. Okay, and look at where he went after that. He went to the first target as right into the first target, and that happens very, very often. All right, so I believe with this example, I pretty much gave you an idea of the importance of risk-free trading and why it is not required to risk a lot, but to risk a little at the beginning and then use risk-free trading to protect your capital and to reach a solid risk. A solid expectancy. Once you have that, you can work with, there are various techniques of money management using other people's money, markets money layers, and actually even simply doubling your risk as you go. But there are many, many ways of actually using money management in order to reach your objectives in trading. You don't have to be right. You have to protect your capital. Okay, so this is my, this is what I wanted to tell you today. Money management can be used to reach trading objectives. One of the things that Van Tarp, I think I said, he has got right. And you can leverage other people's money, markets money. You can use layers, and if you research on FS-Suite, you'll find a presentation where I speak about money management and how to use money management to reach objectives. Okay, so there won't be time to do a market review, but next Thursday, November the 30th, 2017. 7 a.m. if you're here, we're gonna look at the dollar index, euro, and the majors and project them and see where they're going, and I'm gonna give you a great opportunity for the euro as well to trade a continuation higher. So this is it for today. Do you have any questions? Are there any questions there? Adam, Gregor, Nick, Tom, do you have any questions? Is everything clear? Was it interesting? Was it useful? Do you think it was useful? All right. So no other questions there. So thank you very much for joining, and I'll see you then on Thursday. And thanks for giving me the opportunity to talk about this important topic here. And and I have an analysis and trading service as well. If you are interested, just drop me an email. I'm doing free trials at the moment, so just write to fibstalker@gmail.com, and I'll be happy to include you in the group and share the trades. Thank you very much, and see you on Thursday. Bye bye now.